How's everybody doing? This is Xavier Clark here to talk about and show you a little bit about payoffs and payment schedules and amortization charts, and just we're going to talk a little bit about equity as well, but just to kind of give you, again, just kind of a bird's eye view of these topics, so that way you can at least have a working knowledge. A lot of times, people don't really get taught these things, and you kind of have to learn through, hearsay or gossip or through osmosis. And if you're lucky, you kind of get a good teacher or loan officer or financial advisor or what have you, or you just kind of have to get lucky. So hopefully this will at least, again, give you a bird's eye view, working knowledge of all these things. So, I have to kind of put a disclosure, if you will, that, first of all, I'm just using the number 200,000 for these loan amounts. Obviously, smaller loans would change the actual dollar amounts and such. Bigger loans, the inverse of that. And, the interest rate that I'm using, or interest rates that I'll be using, take them with a huge grain of salt. I mean, I don't even like to really say them out loud. They're just vehicles to kind of calculate what we need to calculate, but take them with a grain of salt because, your situation may be different. Rates always change. Is again, just don't focus or harp your mind on any specific number there. Okay, so first thing we're going to look at is an amortization calculator. Amortization basically means you slowly reduce something by paying it off, for lack of a better definition. And so we're going to look at this 200,000 real quick. If you want to start off with your first payment, and we'll continue on with that. So first I'm going to point out that over time, as you can see, a good amount of interest is going to be paid to this loan. At this level, obviously, as rates increase, it becomes a larger amount of interest. And just to kind of show you that, let's say that we were to double numerically the rate, not only would the payment jump, but the breakdown of interest to principal becomes huge. And you can see what that total interest would be, what that total payment. And again, we started off with this number, 200,000. So it gives you an idea again of the importance of how interest rates impact your interest that you're paying on your loan, especially when you're looking at huge differences. So now we're going to look at the monthly schedule, and going back, you can see one of the most important things to realize is early on in a loan, you're going to be paying a huge amount in interest, okay, on this payment amount, which in this case is $954.83. 666, maybe that's no coincidence, 0.67, so $666.67 is going towards interest, and then the rest is going to principal. And after a year, this is the most important thing about these schedules, is after a year you would owe, giving this scenario, $196,477.93. And as you can tell, a lot of this payment, you multiply that by 12, you can see where most of this is going, and why you only end up with that much in what would be a payoff that you've paid off. Good thing, and I like calculator.net. It's a good site. It's very user-friendly, so I use them. There's a lot of amortization schedules out there, but just to kind of, for this video, we're going to use calculator.net. They kind of have a lot of ads, which is annoying, and they just kind of throw rates in your face to try and get you to click, but other advertisements as well. But it's a good site. If you want to, you can toggle back and you can see what you would have paid the first year, what you would have paid down, right, each year. And as you can see, as you go, eventually the numbers flip. On a monthly level, you can also see that through each payment. Now, you might say, hey, okay, I don't really care, right? Well, this is how it does apply to somebody who's using a mortgage to buy a house. And we're going to get into that a little deeper in a second. But the right off the bat, an important thing, and I like to show this to people before they close and after they close, which is, let's say that you were to sell your house. Normally people, sell their house, or, have a mortgage for around 7 years is what they say the average is. But I just like to go even shorter. I think 5 is just kind of a really good number. Not too long, not too short. Either 5 or 3, just depending on the intention of the purchase. But let's just look at, let's just look at 4. So let's say that after 48 payments, which is 48 months, which is 4 years, you would owe still about it'd be $185,027.12. Again, with in this scenario, with these figures, these levels. Okay, so and now again, this is not your sales price. This is your loan amount. So whatever that difference between what you owe and what the house is then worth, according to the market, that represents your equity. So after 4 years, you would have paid off, a touch over 15 grand, plus whatever the house is worth. That would represent your equity. So if you were to sell at that period of time, you subtract, your capital gains after tax. If once you get to that, and any closing costs you pay and any commissions you might have to pay, but that represents what you would walk away with. So it's good to kind of have an idea of where you stand when you're kind of planning these things out, if you go that far. Now, again, as you can see, and I'll just bring it down some more, it takes a while for the interest to kind of catch up to principal, and where it eventually flips. Okay, just to look at something interesting too. Now, if you had a 0% rate, which would be great, right? Then there would be no interest, and they would just divide this by 360 payments, and that's basically what you would be getting at. Every year you just be paying the principal directly, and month to month you'd be paying no interest. Okay, so now to kind of go to the next part of this and then wrap it up, we're going to talk about extra payments, because this is a really important aspect of a loan, depending on your strategy. And here, let me put this back real quick so that it matches up with what we're looking at. But so that you can understand exactly what happens should you decide to pay off a little early or not pay off early. What are the implications of that? Okay, so these numbers should look familiar right here in terms of monthly payment, right? Should look the same. $954.83, $954.83, total interest, total payments. Those should match up. So let's say that we were to add extra payments. And so we're just going to use, let's say that you somehow could muster up an extra $100 a week to put to your mortgage. Now, I know you might be thinking, well, that's a lot of money, but we're just going to look at what that would do. And it wouldn't have to be exactly 400 or 100 a week. It could be, 200 a paycheck, or let's say that you had bonuses or overtime, or, you rented out your house, or tax refund, or whatever you might think. But $400 a month would come out to $4,800 a year. And we're just going to start off with that. We'll look at a different number in a second. But what that would do is you would take your 30-year loan and you would pay it off actually in 17 years. Again, assuming you held it to maturity, which I've already kind of told you most people do not do. Now, you can look at the schedule and see that after a year, without any extra payments, you'd owe, again, this is with these levels, this loan amount, this rate, which you got to take all of those with a grain of salt, and then just look at the larger concepts. But, first off, at the end of the year, you'd owe $196,477.93. But with the payoff, you'd owe $191,588.94. So quite a difference. Now, let's break this down a little bit, because there's some really important considerations in here. The first consideration is if you look at the first payment, and again we're adding $400 a month. This is a strong amount, but or $4,800 a year. So let's say that you look. So let's look at this. Principal without the payoff, $288.16. If you pay an extra $400, it's going directly to principal, right? This is just this plus $400, right? It gives you that. But if you look as you go on, yeah, you're still paying $400, but if you were to add $400 to this, it would actually be less than $713, right? It would be, $698.91. But instead, you actually end up saving a little bit more, right? A little bit, or I should say, a little bit more ends up going to principal than just $400. And you say, well, Xavier, why is that? Because you're accruing less interest. So as you pay off more of this balance, you're actually accruing less total interest to the point of where, you're actually getting a compounding on your savings, so to speak. So after a few years, and again, this is if you're religiously doing this, you look and you say, hey, 400, this is after, again, 4 years. Without the payoff, $336.95 is going towards principal. If you were to just add 400 to that, it'd be, again, just straight 400, would be $736.95. Instead, you got $804.67. So you're actually benefiting over $70 a month at that level. So now, kind of lastly, and sort of wrapping up in this, because I don't want to get too long-winded on it or overly complex. And I also want to say, this is I'm not giving advice. I'm just talking about extra payments and their effects. And again, you got to take it all with a grain of salt as far as the actual numbers, but the concept is the same. So now some people might say, well, hey, that's all well and good, but why don't I just take $400 and put it in a savings account? Or why don't I just take, that money and put it in something else? That would be a highly intelligent question. And so every investment has its place. Okay, so if you're doing your 401k, that's obviously a huge thing to be doing. IRAs, huge things to be doing because of very, very specific tax incentives you get with doing those. Now, you also get specific tax incentives with the house, but that depends on whether you do standard deduction or you do itemized deduction and all these kinds of things. But you do also get tax incentives. But the true thing to consider, and again, I'm not telling you to do this or not to do it, because you could just make the minimum payments, sell your house, or whatever you do. But again, if this is something that you're interested in doing, and again, just to kind of back up, some people will say, oh, well, you definitely want to make extra payments, or yeah, you definitely don't want to do it. Well, this is just to show you objectively what that means if you do or you don't. Anyway, so let's say that over the first year, we'll just use the first year, and as I've already showed you, as time goes on, the benefits kind of compound, so to speak. But let's just look at this first year. All right, so we already know that $400 times 12 payments, that's going to give you $4,800. Okay, so you can almost think of it as you've set aside $4,800. All right. Now, let's look at the difference between what your end balance would be in that time period. So that difference is $4,888.99. So just a touch. So that 99 cents is just a touch on a dollar. So you subtract 4,800 from that, it means you've benefited about $88, so to speak, from just putting it, again, somewhere else and not putting it towards paying off a mortgage early, i.e. just put it in your mattress, put it in a savings account, put it anywhere, even in the stock market. Well, if you were to divide that, and we're just this $88.99, just to make the math a little cleaner, we're going to do $89, round up that penny. that means you're getting a 1.8% return on your money. Now, if you were comparing that to the stock market, that's not so great, but as compared to where interest rates on savings accounts and definitely checking accounts and even a CD, you might be better off. And again, that's with these numbers. But now, if you were to add a higher rate, we'll just bump it up a touch. Those savings add up to even more. And so you actually end up being better off potentially. Again, you have to look at where savings accounts are, where CDs are, all these kinds of things. But you can end up potentially having a better return on your investment. I could go through the numbers at different rates and all these kinds of things. If you want to call me, we could, crunch numbers till our heads explode. But you can see that you actually get benefit. And again, that's after the first year. As you move on, that benefit grows and the rate of return actually increases. And you're paying off the house. If the house increases in value, then you're actually leveraging your money even more. Again, that's if the house increases in value. So you definitely want to make sure you're looking at properties. If you decide to buy, you want to buy a house that's going to appreciate with value. I mean, that's sort of the point. And again, just real quick too, I'm using $400 a month, but you could do the same thing with $200 a month, right? So that's $50 a week, right? You could see similar differences, right? Okay, so $200 a month times 12, you're looking at $2,400 a year. That difference is $24.55.77. So you're looking at about $55.77 in return. And again, you compare that to what that would be in terms of an annualized return. You're looking at a little over 2% in the first year. But then as time goes on, again, that increases. Right. So, and again, that's just $200 a month, and you're getting to pay down your house. So again, it's just an interesting benefit, or I shouldn't even say benefit. It's just an interesting scenario. And so people ask me a lot about making extra payments and things like that. And so again, I just try to put the information out there. One last thing we'll look at too is a lot of people talk about making an extra payment, right? We'll say, well, instead of making 12 payments, we do 13, or some people call it doing it every 2 weeks, which is essentially the same thing. So you make one extra payment equal to whatever your monthly payment is, right? So one time per year. So that would cut several years out of it. If so, looking at this scenario, you do the $1,073.64, and you pay an extra amount of that. You knock off several years here, and again, that's with these numbers, and you can see what that would do. So, again, if you're gonna pay off, or make extra payments, I would advise you to kind of sit down and consult with a loan officer, certainly a financial advisor, and potentially even your accountant, to look at the implications of what you're doing as far as your taxes, as far as your investments, and then as far as your loans. Should you have those things, you definitely want to understand your tax situation as well. And I don't necessarily advise anyone to get loans, but if you are buying a house, this is just an important part of your financial picture. So again, this is not meant to be too involved. Just again, broad strokes, presenting information maybe in a way that you have or hadn't seen. And again, like I said, you can call me. We can crunch numbers till we both explode. Either way, but hopefully this has been a little educational to you. I would encourage you to watch the video I made about how interest rates and down payment can affect your monthly payment. Also, my video about what causes interest rates to be what they are and to move, and also what goes into your monthly payment. Because again, and I don't remember if I actually disclosed that. I think I did, but if I did not, I may not have. These do not include your taxes and insurance, which is, again, if I didn't mention that, it's really important. These monthly payments they do not include taxes and insurance and any PMI you might have, or mortgage insurance, or your homeowners association dues, or your Netflix. Obviously, we're not talking about that, but your payment often includes your taxes and insurance, and these do not. Just repayment of your loan. So anyways, hope you guys learned something, and if you have any questions, reach out to me, and I'd be glad to talk over some things with you. Take care.